And today is 25th of March 2025. First, I will review the ratios. There was enterprise ratio, which was market value of equity plus debt minus cash, which is uh, can be interpreted as the cost to take over the business, and statement of stockholders' equity, which is retained earning plus net sale of stock, or it is same as net income minus dividends plus sales of stock minus repurchase of stock. Liquidity ratio is related with ability to easily sell asset and change into cash. So ratio basically current asset over current liability, or cash plus short-term investment plus account receivable over current liabilities, or cash over current liabilities. Working capital ratio is kind of important that account receivable over its daily sales. If it's too high, then they sell a lot of stocks but haven't received any cashes yet. And for this week, we will talk about uh, chapter 3. Chapter 3, financial decision making and the law of one price, cost benefit analysis, and competitive market, which is one or some group can't determine the price of product. In opposite side, there is monopoly market, such as Korean electricity market decides price by only one company, that government-related company sells, and or oligopoly is also non-competitive market, and auction market is also who bid highest price will take it. For time value of money, it is about cash flow at different point of time. Risk-free interest rate is same with discount factor RF, which is discount rate RF. It's used as discount factor to backward the time flow. And if you want to forward the time flow, you compound interest rate factor. So net present value is PV benefit minus PV cost, benefit cost analysis by benefit cost analysis, which is same as all project cash flows present value is net present value. And you can decide whether we should do a project or not. There's two ways. One is IRR, internal rate return. So check internal rate return to make all the project's cash flow as zero or net present value to check whether it is plus or minus. Arbitrage. Oh, my friend got very good point of view. Arbitrage is related with law of one price. If it is same product, the price should be same, but reality is not. So we can say there is a lot of arbitrage opportunity, which occurs when making risk-free profit. The practice of buying and selling equivalent goods in different market to take advantage of price difference. Maybe in Korea, there is sometimes house price is lower than rent price. We call it kind of using this term, but it will be gone because who use arbitrage get more. House price goes up and rent price goes down to equilibrium price. We refers to someone who use arbitrage as arbitrager. They help market price converges to equilibrium prime. I think one of my friend, what he talk about is law of one price. Think of law of one price. That there are various of price distribution, and there is law of one price, which is in continuous probability distribution. Law of one price, the price probability or law of one price become law of one price is actually zero. So there's every chances are low of chances of arbitrage. You can think like that. Example such as is bond price. If it is fair bond price, which is no normal market with no arbitrage, then it should be present value of $1,000 in 1 year should be $1,000 in 1 year divided by 1.05 in 1 year over today, which in this case 0.05 is the interest rate. What if bond price is lower then we should be arbitrager. So we will borrow from bank and we will buy it. If it is higher, then we will sell the bond and we will invest at bank. Sell the bond and give it to bank. Then bank will give it 1,000 and we will get present value of some money we will get. And separation principle is split investment decision and financing decision. Investment decision is done by MPV or IRR method. Security transaction in a normal market neither create nor destroy value than their own. Job related to investment separates with job related to finance is separation principle. So far in engineering economy, we assume cash flows are fixed, but actually when cash flow are risky, we must discount them rate equal to the risk-free integrate rate plus risk premium. This risk premium, three economists who took Nobel Prize researched about risk premium. And for chapter 4, it was about just time value of money, especially perpetuities, which is when a constant value, constant cash flow will occur at regular interval forever. This is annuity, AW's perpetuity version. If present value of perpetuity situation, we can make A to AI to make it present value, or we can make present value, which is go forever, to multiply I to make AW. For present value of perpetuity, it is calculated by C over R, like what we saw. And there is growing perpetuity calculation formula. And we can, for competitive market, arbitrage, low bond price is what we talked about. And what was interesting was low arbitrage is, if it is not arbitrage, then this equality is not satisfied. This is auction price, determination price. The example what we saw before. One problem that I'm currently solving is if company has additional 1 million depreciation expense, then what would be the impact on expense of global's earning, company's earning? Then in this situation, depreciation, we do more 1 million depreciation, then expense increase 1 million, but tax will be decreased for 1 million's 0.26%, and also cash flow is also increasing. So we should reflect those results today. Thank you very much.